Hello and welcome to A Day in the Life. I'm your host, Darren Bloomfield.
I'm Nir Kossovsky, the chief executive, and the first part, what is Steel City Re, and I'm going to share a few slides, which I just happen to have here in my back pocket. Right, our business is about forging reputation resilience, that is, giving companies the ability to bounce back from an adverse event and still maintain their reputational value. Our products can help companies increase their reputational value. It helps them protect that value, and in the event of an adverse event, restore that value. We do that through two processes. One is offering risk management and governance advice. But what is unique about our business is that the principles by which we offer that advice are built on the foundations of behavioral economics. The two benefits are, one, tactical, and that's basically loss control, very much like any other risk advice. The other is strategic, which is by virtue of the advice, we authenticate the merits of the insurance. So let me hop into the insurance, the other product that we offer. We uniquely offer a parametric reputation and ESG risk financing and transfer solution. Tactically, like other insurances, it covers loss, but strategically and uniquely today, our products authenticate the strategic signal that a firm has superior governance and risk management processes in place. And this signal is the means by which value is created, protected, or restored. The idea of using insurance, or the idea of creating value through strategic signaling, is ancient. The best understood use of strategic signaling, the most powerful use of strategic signaling, has been in the world of nuclear arms control, and the classic concept of mutually assured destruction, by letting each nation know, or that the other nation had enough firepower to destroy a fellow nation in the event of a war. We, as a world, theoretically have so far effectively avoided a nuclear war. But the key to this strategic signaling is that each side is communicating what it is doing. So it is the communication of the power and the potential that actually creates the value, not the actual event. And I have a wonderful video clip from a classic movie, Dr. Strangelove, that sort of affirms this value of signaling by telling the world. And let me give some context. If you're playing the game of chicken, that is two cars driving head to head at each other, and the game, as the game is played and has been played over the years, one of the drivers will at some point veer away, and that's the loser because they were chicken. The strategy for winning the game of chicken is to rip the steering wheel out of your vehicle so that you do not have the ability to stop the impact, thus forcing the other person to make the decision on whether they will destroy themselves or avoid the collision. And that was the principle that was captured in this movie, where the Soviets had built a weapon, in theory, that was a doomsday machine. If the Soviets were attacked, this device would destroy the world. It was that simple. There was no human being involved, no decision-making. An attack on Soviet soil would destroy the world. The point, of course, was that the world had to know about it. And that's what's illustrated in this little video clip here from that movie, where Dr. Strangelove, modeled on Henry Kissinger and played by Peter, blocking his name, Peter Sellers, thank you. Yeah. Transferring or channeling Dr. Henry Kissinger is explaining to everybody how this doomsday device works.
It is essential. That is the whole idea of this machine, you know. Deterrence is the art of producing in the mind of the enemy the fear to attack. The doomsday machine is terrifying. It's simple to understand and completely credible and convincing. Is that the whole point of the doomsday machine is lost. If you keep it a secret, why didn't you tell the world, eh?
Yeah. And that's central to the principle under which Steel City Re operates, is that the real value created in our solution is when the rest of the world, the stakeholders, are aware of the presence of the risk management processes, and that's best told simply and credibly through insurances.
So yeah, it makes a lot of sense of like this protection being in place to have like this like signaling to the clients and customers that you've thought about this as the company. But then what's that kind of process of like the underwriting of Steel City Re and the carriers of, because I would imagine some applicants would be declined to getting this type of insurance if there was kind of an adverse risk with them.
Well, certainly there's an underwriting process that filters between those that have and those that don't have appropriate or adequate risk management processes. And for those that don't, we have an advisory service to make that real. But perhaps before diving into the nitty-gritty of what we tactically do, perhaps it's best to kind of share what exactly reputation risk is. Because for many, this is for many it's not an obvious concept, and it's an evolving concept. So with your permission, I'd like to share just a little bit about what it is. Great. Well, look, I just happen to have more slides. So reputation is a very simple concept in that it's the reputation value is the value of anticipation or dread. That is, looking forward to something, one will have a certain form of behavior, and all stakeholders will have some behavior in anticipation of something great or in the avoidance or fear of something awful. So the value is forward-looking, as illustrated by these three gentlemen waiting to see what's under the dome that's being served to them. Or fearing that it may be something absolutely awful if my mother were cooking it. The risk to reputation value is the threat to that value of expectation. In using insurance world language, the hazard that makes it potentially much worse is that there is a gap between what that expectation is and what the likely outcome will be. When that gap is exposed, we have risk manifest. And one of the characteristic features of reputation risk is that it's emotional. That when it manifests, there is anger, there is disappointment, illustrated by the small protest shown at bottom right. The most important concept to lift from this is that reputation risk is essential, and its management, reputation risk and its management is essentially a battle for the control of the mind of the stakeholder, hence the importance of signaling. This concept goes back 150 years. So this amazing innovation that Steel City Re has brought in terms of being the first to offer parametric reputation insurances and behavioral economic models is only based on some ideas that were developed 150 years ago, only most recently affirmed with the Boeing 737 MAX, just as an example, using two transportation concepts here, which is that there is a cost of loss that we understand very comfortably in the insurance world. And there is a cost of fear, of dread, which is not that well understood, but is yet very well perceived and sensed in a gut sense by everybody. And last, I'll show that back in 150 years ago, this is what I looked like with my colleague when we began our business as models for a trench coat company.
Yeah, so that makes a lot of sense of just kind of like say there's a bad event and it's kind of like an unexpected event. And then if you're like a publicly traded company, then your customers or your stockholders might sell stock because they would kind of assume that the stock's going down. So kind of this would be a product to help counter that, of instead of assuming the worst and that the company doesn't have this under control, this reputational harm product would kind of reverse that effect or even protect kind of against that?
That's exactly right there, and that's the general notion. Um, that's the general notion of how it works, but it's a relatively new concept. As old as it is, it's a relatively new concept that's how insurances would work and sort of the effects. Let me kind of run you through kind of the evolution of the understanding of reputation risk and where we are today, and bring in not just the shareholders and the customers, but the entire ecosystem as we understand it. This next slide represents, if you will, one facet of reputation, which most everybody sort of concentrates on or focuses on in terms of the publicity. And this is a word that was introduced into the German language about 10 years ago, when there were a number of riots in Europe associated with issues with the European Central Bank and finances in some of these southern European countries. And it refers to the adverse publicity and all this stramash, to borrow a Scottish term, that's associated with it. But there has been an evolution as the understanding of reputation risk has bounced around between regulators, auditors, marketers, and insurers. Everybody's had an aspect of it. It's kind of like the wise men and the elephant. Everybody saw something of it. And Steel City Re was in the position of being able to put it all together. What is interesting is that the regulators were the most attuned, because even in 1996, as they were beginning to try and make sense of the market collapse as a result of fear associated with long-term capital and other craziness, they connected the notion of liquidity crisis to negative public opinion, but critically they said it was the economic harm was the result of negative public opinion, as opposed to negative public opinion being the last thing that happens. That is, negative publicity from an adverse event. The regulators said, no, there's more. After the negative public opinion, then you start having liquidity crises, and people don't spend money and they don't lend because they don't trust. That was back in 96. And at that point, the regulators, the Office of Control of the Currency, created new standards for the banking industry, requiring them to disclose how they managed 8 strategic risks, with reputation being one of those 8 named perils. The marketing community always knew there was some relationship with emotions, brand and identity and emotion. So it kept kind of bouncing around with the emotional element. The insurance world, as far back as 2005, published an article in The Economist defining reputation as the risk of risks. It was the ultimate risk. So the insurance world got it, but the auditors, the committee of sponsoring organizations, had nothing really constructive to say. I should say, really doesn't have anything yet constructive to say in terms of risk management, which sort of likens the committee of sponsoring organizations, the audit world, to sort of like the pathology world that I came from. The joke being that the pathologist knows everything about everything too late. Yeah. So today, the complete or comprehensive notion of reputation risk is that there's a stakeholder world, and we're all talking today about stakeholder interests and stakeholder activism and so on. So there are stakeholders, and they are very important. They are the customers, employees, vendors, creditors, equity investors, regulators, non-governmental organizations, social license holders. All of them are stakeholders. And when something leaves them angry or disappointed, they will react. And there will be a pylon of the media and the social media and the litigators and the regulators, but the going forward cost of fear or anger or disappointment are in reduced revenues, increased costs of goods sold, increased costs of the sales, general administrative services, increased credit costs, reduction in net income, and ultimately enterprise value loss. And that's a going forward consequence of an adverse event, which the regulators understood in 1996, and the world more or less understands it today in 2000, almost 22.
Yeah, no, that's a really interesting way to put it, with like reputation is the risk of risk, but then this product of kind of buying insurance for it seems to be a very like new concept. And just with like new products, there's not the data there that carriers usually use to predict these losses, law of large numbers, and just kind of actuarial tables. involved with that. So can you kind of talk about like that process of finding the capital, going to a carrier and pitching this?
I appreciate your eagerness to jump into the tactical aspects, but as you shared with me before this call, you've been studying history and you've suggested this is brand new. And my friend, we're going back to 1857. We're not new at all. It was a discovery in the late 1850s and 60s that made our world possible. And I think it's important to provide that context because it's truly a milestone in the history of insurance, and perhaps a lesson lost from the 1860s that we are rediscovering today. All right. Oh, look, a few more slides. All right. So the story begins with a club, the Polytechnic Club in 1857 that included a number of engineers. This is all in Hartford, Connecticut, by the way, which was the Silicon Valley of the mid 19th century. Among the members of the Polytechnic Club were Francis Pratt and Amos Whitney, who engineered a power company and are now very famous for their jet engines. Of course, they didn't make jet engines back then. Elisha Root, who mechanically developed a fabulous pistol, the Colt revolver, which saw extensive action in the Civil War to follow. And Jeremiah Allen, who was an engineer and founded the Hartford Steam Boiler Inspection and Insurance Company. Note the sequence of those words: steam boiler inspection and insurance, risk advisory and risk transfer. And this club discussed matters of science relative to everyday life. And one of the everyday life events at that time was the explosion of steam boilers. The world was powered. Now, mind you, the electrification was to occur maybe in the 1880s when Edison created his first power station in New York at Pearl Street. So we're now 30 years before electrification. Power is steam, coal, water, and that's Hartford. And steam boilers are blowing up fairly regularly. And they felt that there was a way to reduce this risk by inspecting it. Anyway, that was a discussion. And then in 1865, April 27, 1865, the steamship Sultana exploded on the Mississippi River while transporting former prisoners of war, Union prisoner of war, to their respective homes. The steamship exploded, killing 1,168 individuals, which was the greatest maritime loss of life in the United States ever. Context, the Titanic, which was a British disaster, lost 1,517. Greatest maritime destruction in history. And it wasn't such a big news item because President Lincoln had been assassinated 2 weeks earlier. John Booth had been killed the day before. So there's a news covering the newspapers. But this was the greatest tragedy. A year later, Hartford Steam Boiler Inspection and Insurance Company is founded. And the principle was that they would push the product of inspection by guaranteeing it with insurance. And that was the concept. Right? What the founders of Hartford Steam Boiler Inspection Insurance Company did not appreciate was that while the customers of their service appreciated the inspections and thought the insurance was pretty cool, kind of affirming the quality of the inspection, the real value was that people were willing to use buildings and ships powered by the steam boiler because of the inspection and the insurance. That is, the presence of insurance made the users of the product comfortable that it would not explode. Insurance mitigated the risk. That was the lesson not intended but learned. That lesson was formally applied 50 years later in the collapse of the world economy. The Federal Deposit Insurance Corporation was formed to mitigate fear of bank collapse. Could not cover all the bank losses, but by insuring deposits, depositors weren't afraid and therefore continued to use the banking system, stop the run on the banks, and essentially save the global economy. The insurance product mitigated fear. And that was the lesson that Hartford taught everybody. All right. So with that lesson, insurance clearly has a new role, and that's kind of what we put together, if you will, in ultimately producing the combination of advisory services and the insurance services to provide comfort to the stakeholders of the firms buying our solution, that the firms have superior risk management and risk governance. Same logic as Hartford Steam Boiler Inspection and Insurance Company, same logic as Federal Deposit Insurance Corporation.
Yeah, I really like the way you said it of like the insurance product mitigating the fear. But even with that in mind, there's like already so many different markets of insurance. Like you can buy insurance for pollution liability, you can buy environmental insurance, you can buy the directors and officers insurance. Like where does reputational insurance kind of come into that and kind of fill like that gap?
Well, it's kind of interesting when you mention directors and officers liability insurance, because when it was first rolled out, it ran into the opposite problem. When directors and officers liability insurance was first developed in the 1930s, in the context of the Federal Deposit Insurance product, with the same concept that surely directors and officers liability insurance will provide assurance that firms are well governed. The reaction was the opposite. Companies were concerned that if they acquired directors and officers liability insurance, they would be signaling to their stakeholders that they were afraid of something adverse happening. And so companies essentially did not buy insurance, D&O liability insurance, until the 1980s. In the 1980s, companies discovered that they could be sued without having actually to do anything, just by having a stock price drop. And this was around the time of the Arab oil embargo, where the market was exceedingly volatile, and directors are being sued for stock price drop. Directors and officers liability insurance went from essentially no market presence to full market saturation over a 5-year window, as companies realized they needed the product. The earliest purchasers of D&O liability insurance bought it not to cover the directors, if you will, but to signal to certain directors that their company was worthy of the world's best directors, and as a recruiting tool. So again, insurance was a signaling instrument. D&O insurance was a signaling instrument to recruit the best directors of the best companies, on the premise that only the best companies could acquire D&O liability insurance. And that's the critical.
D&O, they would think there was something wrong with you. That's like, why do you not have D&O?
Right? Completely flip the interpretation of the signal. So the point you were making, Darren, about there being many different insurances is true. But when an insurance becomes a commodity, there's no real signaling value to it. When an insurance is bespoke, there is tremendous signaling value to it. And that was the point you had raised earlier, saying the underwriting process is highly discriminatory. That is, superior firms with governance processes in place will qualify for coverage, and those that do not have a robust enterprise reputation risk management apparatus in place will not qualify for coverage.
So what are you seeing with kind of that curve you described of D&O? First, it was like, hey, why do you need that? What are you doing wrong? But then it was like, why don't you have it? Are you kind of seeing a similar curve with the reputational harm insurance?
Yes, we are, and I'll try and compress the story. But this is the year where suddenly directors have discovered that they're exposed. And it's a combination of things. First, the combination of all these social media driven popular issues, hashtag Me Too, hashtag Black Lives Matter, hashtag diversity, equity, inclusion, hashtag meteoric jury verdicts, that is, have transformed reputation risk from a concept to a very much in the street, in your face experience that is staring all directors immediately. I mean, it's visceral. You have changes in the courts of law. In Delaware, the courts have essentially said that director is not being dutiful in their principal duties of oversight and governance if they're not aware of that which is mission critical to a firm. And mission critical is sufficiently vague, but it's sufficiently novel, and it was not something that firms focused on until essentially a year ago, even less than a year ago. In the capital markets, the almost passionate obsession with these issues of environmental stewardship, social justice, and quality governance, ESG, as we call it, right, has become a basis for director reappointment, director votes through proxy advisors, ESG metric systems. All of this has gelled just this year. I mean, so you have three massive things facing directors, all that more or less have gelled this year, from the street, from the courts of law, from the investment community. Add on top of that the regulators, who are now trying to figure out how to make sense of all of this, with the threat of some regulations coming down the line with respect to all of this, and the fact that COVID is not going away. You have a profound risk environment that is painting the sort of underscoring how critical reputation risk management and governance is to all stakeholders, with the failure that is by leaving any of the stakeholders angry or disappointed, significant economic consequences will be experienced, and directors will largely experience something personally, and that is, asked to leave board, lose votes for board support, and so on. And that makes it a very personal matter. So this is the year where we're making that transition.
Yeah, definitely. Can you kind of go deeper in some examples of kind of like those triggers that can lead to a claim, or like previous examples in history, so then people would be more aware of what to look for, of kind of like, where is this exposure?
Well, let's see. We could go back, I don't know, 3 months.
Sounds good.
Just take some random sample. Let's see. On the far left, a safety issue. Alleged that Boeing, the Boeing aircraft company, Boeing Incorporated, did not have a board oversight of safety, where safety is reasonably felt to be mission critical to the value of their aircraft. There used to be an old saying from pilots was, "If it ain't Boeing, I ain't going." Yeah, I mean, safety was the brand of Boeing. Well, among other things, so safety is an issue, right? And just as an aside, early November, Boeing settled the second highest derivative litigation, reached the second highest value derivative litigation settlement of $237.5 million, about 6 weeks after a Caremark hearing went against them. Ethics, Facebook, and trust. This is going back to Cambridge Analytica, and all the issues that have bubbled up since then have severely eroded Meta's reputational value. So much so they had to change their name, which you may recall from history worked very well for AIG after the meltdown and the bond market and mortgage market collapse. When they became, what did they become? AIG changed its name ever so briefly, but they've returned to AIG. Quality. Credit Suisse's quality risk management process completely collapsed, exposing them to Archegos, a firm run by a fellow who had been previously convicted of issues which cost them a good $4.7 billion. So the top issues, if you will, you could say ESG for short, but more specifically, issues in the areas of ethics, innovation, safety, security, sustainability, and quality. These are the top issues that stakeholders care about. And when stakeholders care about them and are left angry or disappointed because there's a gap between what they expect and what they're experiencing, there may be a reputational crisis arising. Right? Different in every sector, industry sector. Certain things are more important than others, but those are the big six, and ESG wraps into that.
So then what's kind of like that positive impact of, if these stakeholders go in to like the stock market, looking at a potential company to invest in, with just kind of these fears or concerns, as you just outlined, if that company does have this ESG or reputational insurance coverage is there, kind of a positive upside on their stock price then?
Actually, yes. The evidence shows that when the market becomes aware, the value of signaling, when the market receives a signal that shows that there is superior governance and risk management, the market responds favorably. First, the more subtle things. We know that the three major credit rating agencies all incorporate reputation risk management into their calculations for assigning credit risk, because reputation is a major cause of cash flow challenges. As I said, known back to the regulators in '96. Second, we know that the largest ESG rater, MSCI, specifically focuses on risk management as the foundation for its ESG ratings. When it rates a company, it doesn't say, how are they managing, let's say, water risk or water exposure, water utilization? Rather, they'll ask the question, this company has certain water regulatory requirements they must meet. How well are they meeting them, or are they at risk for being sanctioned for not meeting them? So it's a risk management foundation for MSCI's ESG ratings. And there's an article just a week old in Bloomberg Law going through this in great detail. Okay. So risk management counts there on the rating side. And now some specific examples. More general examples. We know that the proxy voting guidelines from BlackRock, which they've published, BlackRock being the world's largest asset manager with something in the order of $11 trillion in assets under management now, which means it controls about 6% of all equity shares traded in the world, has specifically asks in its interviews with its portfolio companies how well they're managing reputation risk, and they ask the same questions we ask in terms of the foundations for our advisory work. How do you as a firm know what your stakeholders expect? How do you as a firm either meet those expectations, change the expectations of the stakeholders to align with what you can actually do, or finance the gap between what they want and what you can do when there's a risk of some adverse reputational crisis? These are all part of the proxy guideline that BlackRock uses. But now some specific examples, borrowing from history. We can look at, compare and contrast the way that 2 or 3 years ago, Merck, the CEO of Merck, Ken Fraser, shortly after the Charlottesville riot, the firm took a very strong and unambiguous position in terms of social justice, and they withdrew from certain presidential commissions, and relative to the market, their stock price rose by about 3%. Contrast that with a Coca-Cola company that took a very, we'll say, struggled with articulating a clear position after the Georgia vote earlier this year, and their stock price underperformed the equity market by 3%, both taking place over about a 30-day window. Compare and contrast in the outset of COVID about 2 years ago, when the Marriott Corporation announced within a month of the big onset of the COVID curtain that they had put together a committee to discuss ways to manage the risk and the safety fear of potential hotel guests. And their stock price bumped by about 2 or 3%. Compare it to Hilton that said, we're doing that, of course, and we have invited the Mayo Clinic, one of the great authorities on infectious disease, and we invited Burkitt Rexall, one of the great producers of Lysol brand disinfectants, to be part of our process to develop solutions for addressing the safety fear of our guests. And their stock price rose by 8%, again, outperforming because it was a much more credible, authenticated story of process. And then we have a great example just this past June, when Apple Inc., knowing that privacy is a major issue on the internet, announced that all of their products and software now had new security and privacy features built in that would help protect the users. And over the next month, they outperformed, that is, Apple outperformed Google and Facebook by about 9%. Then in August, they announced that actually there were some exceptions to that rule, and they were scanning everybody's pictures for potential child pornography. And then they underperformed those same two companies by about 3% because privacy experts were disappointed in Facebook's slight walking back their strong position. Just as an aside, I saw today in the Financial Times that that position Apple took cost WhatsApp and some of the other major users of data some $10 billion. So these specific examples of companies signaling either overtly or subtly that they understood what the stakeholders were expecting and were meeting it through process change produced quite significant changes in value, bumps in value, or erosions of value if they left them disappointed.
Can you kind of expand on that concept of what the shareholders expect, what the company can do, and then kind of buying insurance to kind of bridge that gap? Because I think that would be something hard to, as a company, as the insured, to kind of think about, is how much insurance to buy. Is there a way to kind of benchmark that with peers and peer groups or recent competitors, like similar size, similar revenue size, to kind of benchmark that and project like how much reputational harm insurance they should buy?
Sure. They need two products because there are two answers to that, because there are different audiences for that question. One audience is the capital market financial community, the bond raters, the ESG raters, the institutional investors, who are more interested in process and quantitative elements. Other stakeholders are far less interested in the quantity and are interested in simply the quality. That's very important for them, that it exists. Right? So one is a binary issue. Strategically, it's a binary issue for most stakeholders, and it's a quantitative issue for the markets. What Steel City Re recommends for companies is that they create a captive or use their captive to cover differences in conditions or tactical exposures that are associated with all of these common risks, the recall risk, the products liability risk, the EPL risks, and so on. All of those have immediate costs and going forward reputation consequences. The conventional insurance will cover the immediate costs. Reputation insurances in the form of captive can cover tactically whatever the capital exposure is, and part of the calculations are what Steel City Re helps a firm do, as well as setting up an entire enterprise reputation risk management apparatus to calculate on its own every month what those potential exposures might be, just like banks calculate value at risk right now, through models. The signaling part beyond the institutional investors and capital markets is a binary need. There should be insurance. Its presence is the value. And for that, we strongly recommend a nominal amount, 5 million, 10 million, 25 million in reinsurance of the captive through our London markets, with Tokyo Marine Kiln being our principal underwriter. That is sufficient to send a signal of real money by a real third party, authenticating the captive's value, authenticating the risk management value, and wrapping up the story for all stakeholders who appreciate and value.
So what's kind of the distribution strategy involved in that? Because you're kind of talking about like the insureds having a captive in place and kind of doing reinsurance over their captive. So like, are you using retail brokers or using wholesale brokers, or how are the insureds kind of buying this?
Sure. Steel City Re works exclusively through brokers, and these are the brokers that tend to have large company clients who are providing enterprise level solutions. So for brokers who have relationships with boards and are providing the full range of enterprise type exposure solutions through conventional insurances. And I think some brokerages call them specialty insurances. And these will involve EPL, recall, DNO, ENO, that type of exposure. Those are the types of brokers through whom we sell or provide the solution. But to be clear, the general chain of sale for our product begins at the board level. That is, the board understands they have an exposure. The board typically turns to either the CFO or the CLO, legal officer, and says, we're looking for a board level governance exposure for all the reasons I shared with you earlier. And then the order comes down to usually the enterprise risk manager or the risk manager to make it so. To your prior question of pricing, how much do you need and so on, it's very much industry specific, and within every industry, it's very much company specific. And I'm happy to put up a chart just showing the range of rates that would be required for firms looking to attach at a tactical level through their captive what we've recommended over the years.
Of course.
So pulling up just another handy slide here in my back pocket. What you're seeing here are rates from 2016 in light pink, 2018 in a darker pink, and red, which would be last year's rates. And you can see that there's quite a range between various industries, from commercial services and communications or consumer durables. Back in 2016, non-energy minerals, these are the minerals that were used largely cobalt and other fine electronic minerals. This is about the time that what they're called conflict diamonds became a big issue, and child slave labor in cobalt mining became a big issue, and Sarbanes-Oxley was being applied against companies that had engaged through in unethical labor practices around the world. They were exposed to a lot of fines and litigation, and their insurance costs peaked then. To the extent that we were recommending an average of 15% rate online for a captive to cover that kind of tactical loss. Since then, it's dropped down to about 6 or 7% last year. You can see quite a range depending on any industry sector and the year and what the top social, environmental, or governance issue is of the time. That's what bubbles up. And that's perhaps the most important point, Darren. These issues, there's an issue a week, the crisis du jour. And historically, boards approach these as one-offs. We have a crisis this week with ESG, the next week it's with Me Too, the week after that it's BLM, the D&I, whatever. And there are too many. It's overwhelming because the social issues, the governance issues, the environmental issues, the big six: ethics, innovation, safety, security, sustainability, and quality. These issues are here to stay. And the ability of companies to address them and bail out and manage them is no longer sufficient to have a one-off. There isn't enough time to address all these crises and still address the enormous load that overseeing a company requires, and for the other governance issues. But they're mission critical. They have to be done. And so we are recommending, as part of our advisory services, that firms establish a standing enterprise reputation risk management organization led by a reputation leadership team, supervised by general counsel or chief financial officer in some instances, but increasingly the chief legal officer, because so many issues are now legal, overseen by the board, and then, of course, having controls and insurances to drive home the story.
Yeah, no, definitely. Well, thank you so much for coming on and explaining such a unique and innovative concept. I'm very happy I met you at RIMS in Chicago and kept in touch.
Thank you so much. It was a pleasure to be here.